Thanks so much for tuning in to this post-policy conversation with somebody who I have the highest regard for in understanding the macro and the micro and trying to apply that to investing at large and the economy at large as well. Mr. Nilesh Shah, Kotak AMC Johnson right now. Nilesh bhai, thanks so much for joining in. Much appreciate you taking the time out. Uh, what was the telling part about this policy statement that the MPCs laid out today?
I think the RBI is like a batsman who is betting on a fifth day test pitch, and the bowling is quite hostile. Global events, inflationary concern, growth concern, stability in financial market, everything is hostile right now. And RBI calmly conveyed that main hoon na. They are juggling between growth, inflation, and financial market stability in a commendable manner. They are proactive, they are data dependent, and they have ensured that our inflation, while it is higher, does not go out of control, while our growth, it has been lowered, does not fall through, and financial markets continue to function as normal. I think it's truly an amazing achievement by the RBI.
You reckon the markets were pricing in some bit of hawkishness? I mean, 50 basis points was probably priced in. Were the markets pricing in some bit of hawkishness? I mean, the resultant reaction in the yields as well as what the bank nifty or the equity markets have done, does it kind of tell you that?
Undoubtedly, market was pricing in 50 basis point rate hike, though the expectations range from 35 to 60, but average 50 was quite reasonable. And with the evolving global situation, my feeling is that markets were also pricing in little bit of hawkishness from RBI. We have to be follower of US Fed. We have to raise rates in sync with them. We have to cut rates after they start cutting the rates. So in some sense, some hawkishness was necessary.
There seem to be okay. Let me first do the policy things and then I'll come to growth. In a manner of speaking, Mr. Shah, the fact that the RBI alluded the governor alluded in his statement, the initial statement, that the way growth is for banks as well, right, on the credit side versus what's been done on the deposit side. And then later on in the press conference, almost saying that, or almost coaxing that we've done a lot, the RBI has done a lot, now it's up to the banks to go out, and he hopes that the banks will consider and tinker with the deposit rates. What did you make of that statement? And do you reckon that a change in deposit rates, it's around the corner?
So undoubtedly, bankers will have to take into consideration guidance from the RBI. And this has come in public platform. But at the end of the day, as of today, clearly deposit rates will be driven by two things. One, systematic liquidity, which steadily has come down as RBI has intervened in the FX market. It can be supported if there is open market operation by RBI on the government securities side. And the second thing will be banks' own asset liability mismatch or liquidity mismatch. So we do believe that slowly and steadily deposit rates will rise, reflecting RBI's policy rate movements. And this will be primarily concentrated at the shorter end. I don't expect medium to long end rates to rise, primarily driven by the fact that markets are now pricing in a sharp U-turn by the central banks once inflation comes under control. We did see very surprising movement by Bank of England. And I tweeted yesterday that the Bank of England is driving a car where on one side they have pushed accelerator, that's, raising interest rates. And other side, they have pulled brake, which is intervening in gilt market to support prices and providing liquidity. We don't know how the car will move. So clearly, because of that kind of scenario, I don't think so people will tinker with mid to long-term rates as much as they would like to tinker with the short-term rates.
Yeah, it begins the question: is it quantitative tightening, quantitative easing, or quantitative confusioning? In that sense, that was also one tweet that came out. Mr. Shah, so on the liquidity front, as you mentioned, is there a near term, not a risk really, but a near term challenge, if you will, considering that we are in the midst of the festive season, cash withdrawals may be fairly high as well for the ensuing next 30, 45 days. Could there be a challenge, or do you think not so? I mean, there was not enough emphasis on liquidity per se. Maybe none is needed, but I'm just asking your view.
So undoubtedly, we have seen after almost 2-3 years of consistently positive liquidity, 2-3 days where overnight banking liquidity was in deficiency. This happened because GST and advanced tax outflows moved out of banking system to government accounts, and it took little time before government could spend that money to enter the, for money to enter the banking system. So bearing those uneven patches, we believe liquidity will still remain in surplus. And RBI didn't mention much about that because it's kind of taken for granted by the market that liquidity will remain in surplus.
Got it. Um, One question on growth, and then I would also want to correlate asset markets to the policy moves. On growth, the governor sounded sanguine. The numbers relative to all other major markets are like that. And just before we started this interview, you mentioned this comment by Michael Patra as well, Mr. Shah. What did you feel about the RBI's confidence on growth? And what's your own sense about what happens over the course of the next 6 months, considering the world still seems to be, nervous or on the edge at best?
So undoubtedly, Neeraj bhai, the world is moving into reverse direction. Growth is slowing down across the globe. And as central bankers take away liquidity and tighten rates, there will be more adverse effect on growth. In the Indian context, growth estimates have come down from, let's say, big figure 8, 9, and 10 to now big figure 7. Some might will even go down to big figure 6. In the global context, this number looks reasonable. And I'm glad that RBI has bitten the bullet by revising growth downwards and maintaining focus on the inflation. Uh, Overall, we believe over next 6 months, challenge to the growth continues to remain high. We have been little bit blessed with lower oil prices, which has taken away some pressure on the growth side. But clearly, if global growth slows down, there will be impact on our exports of goods as well as services, and that will have impact on our GDP growth.
What does that do to both uh, reserves, flows slash reserves, and the currency, Mr. Shah? Because again, the one thing that the governor was unequivocally confident about was the buffer of forex reserves that India has. It was clearly a number that everybody was watching out for because of the recent turn of events. What did you make of that? And what's your sense about what could be the state of the currency, as well as would the markets at any point of time get nervous about the forex reserves? Even though, I mean, we may wait over the crisis, so to say, if there is one, but would the markets, do you think, get nervous of the quantum of forex reserves that India would have?
Undoubtedly, we believe rates, currency, and equity markets are all correlated. They will be driven by local as well as global factors. On the currency side, RBI has always followed the time-tested formula. Let market determine the direction. We will intervene to control the volatility. This policy has worked well for India in the past, and it should continue going forward. In terms of flows, I think while global storm can impact near-term flows, longer term will appear like an oasis in the desert. On a equity side, on a 1-year basis, we do look expensive vis-a-vis peers. But on a 5-year basis, we look like the cheapest emerging market. With our growth, governance, and green, we offer an unparalleled story to global investors. So there will be some volatility in the flows, but I believe thanks to China plus one, thanks to our 3G of growth, governance, and green, foreign portfolio as well as direct flows will continue to come to India. We do have some challenges on the external side, but they are well within our manageable levels.
Hmm. Good to hear that, Mr. Shah. One question. Late or rather early this morning, our time, FTSE Russell has, of course, said that the Indian inclusion in their emerging market bond index is now still a consideration, but in 2023, we're still waiting for the big one to come by. If that were not to happen, Mr. Shah, in the near term, do you I mean, what's your sense? Are bond and market investors, global, local, as well, positioned for India's inclusion to happen sooner rather than later? And if that doesn't happen, is that a challenge in the near term that might be difficult to kind of quantify, maybe?
So as of today, clearly market was not factoring in bond inclusion at the initiative of the government. It is the investors who are telling agencies to include Indian bond in the indices.
Yes.
There are primarily two mode of contention. One on the taxation side. Globally, investors prefer tax exemption. India has refused to provide that as it creates an uneven level playing field between global investors and local investors. The second thing is related to settlement. Most global settlement systems are anonymous. Indian wants a settlement system where we will know who the ultimate beneficiary is. These are two contentions where I believe investors will be able to prevail over agency. It's far better to invest in Indian bonds, which have been defaulted over the last 5,000 years since Harappa Mohenjo-daro days all the way till today, rather than go into countries like Russia or Sri Lanka, where defaults keep on happening on a regular basis. So my feeling is that this time it is investors who are pushing agencies, and our markets will be positively supported in terms of yield if inclusion happens. The negative impact will be bare minimum if that doesn't happen.
Okay, so you do believe that the should that word to get delayed, and I don't think a delay is a denial, but should that were to get delayed, Mr. Shah, it's not something that is a surprise of sorts, or something that can really have a telling impact on the way the yields or the currency moves?
No, I don't think so. If it comes, it will help in lowering the yield and maintaining currency at current level. If it doesn't come through, then markets will anyway follow its natural course.
Got it. My final question, I know you referred to how India on a slightly longer term tenor seems to be a really cheap emerging market relative to what it is looking right now, which is at a substantial premium. The question would be, would you believe that the near term challenges around the world for the other markets might have near term further pressure on Indian equities as well? Or is it the case that some of these pressures have been priced in, and if inflation globally starts showing a bit of a downtick, as in the US, we're seeing crude prices, used car prices, etc., coming off, if indeed that were to show up in data, you think risk assets would actually have an upward trajectory?
So it all depends upon how we go and market ourselves. The world has seen where Dow was in a narrow range, and Japan continued to move upwards in the 60s and 70s and the 80s. Clearly, a local economy which is growing, where earnings growth is visible, where governance standards are at par with the best in the world, and where there is consideration for environmental concerns, I think that combination of governance, growth, and green will ensure that our markets decouple with global markets. As long as my economy does well, we will get differentiated. We have seen how US dollar has risen against all other currencies on technical factors. It's not that US economy is doing particularly well. For last 2 quarters, they have seen negative growth, and yet their currency has appreciated. That has happened on a technical factor. We can actually decouple on a fundamental factor, but for that, we must ensure that our economy remains on a higher growth path. inflation remains within RBI's comfort level. Our FX intervention is to measure volatility rather than direction. If we achieve on those three combination, I'm sure our markets will get decoupled vis-a-vis global markets.
Well, let's see how it shapes up. Let's see how the cookie crumbles. But firstly, take a moment to thank you, Mr. Shah, for joining us today and giving us your side of how you saw the policy. Really appreciate your time.
Thank you.
And happy Navratras and a very happy festive season to you.
Yes, Ajay, green shirt pehriyo chai.
Well,
Navratri color.
Navratri color. Okay, I should have worn the green shirt too. But Mr. Shah, thank you so much for joining in today.
Okay.
And viewers.